It's time for the Your Personal Bank Show with Ferenc Toth. In an era of chaos, confusion, and craziness, Ferenc is a voice for common sense. As a financial literacy educator, speaker, and entrepreneur, Ferenc cuts through the noise to help us understand how current events affect our money, economy, and our freedom. Now, here's Ferenc Toth.
Welcome to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. So recently, Chipotle was down significantly in their earnings call where they warned the economy is terrible for anyone below the age of 60. The Chipotle CEO stated that consumer sentiment has declined sharply. We've seen broad-based pullback in frequency across all income cohorts. And since then, the gap has widened, with low to middle-class income guests further reducing frequency. We believe this guest with household income below $100,000 represents about 40% of our total sales, and based on our data, dining out less often due to concerns about the economy. A particularly challenged cohort is the 25 to 35-year-old age group, and we believe this trend is not unique to Chipotle and is occurring across all restaurants as well as many discretionary categories. That is a really poignant and powerful statement about the current status of the economy. And it really boils down to, outside of AI stocks, the economy looks recessionary. Most stock charts look horrifying, and the market is acting like the consumer is dead. Another economist recently stated that unless you have a large stock portfolio and own your home, the economy is not working for you. The percentage of subprime auto loans that are 60 days or more overdue has hit an all-time high. This is according to Fitch. U.S. serious credit card delinquencies are now at crisis levels. They are at the highest levels we've seen since the 08-09 financial crisis. They are rapidly increasing and are nearly at the same levels. They continue to tick higher. And this only happens when the economy is collapsing. As I always say, a person doesn't rack up max their credit card debt or not make their car loan payments if things are going well. And the leading economic indicator index, this is something that I've shared on this show for quite some time. It's a cross-section of a number of leading economic indicators. It has now crossed into negative territory. This is only the sixth time since 1950 that has ever happened. Every single time, the leading economic indicator index has moved into negative territory. It's not just down, it's negative. There has been a recession. So if we don't go into recession this time, it would be the first time that the leading economic indicator index was incorrect. It's a leading indicator, folks, so it's a great measuring tool or a red flag. And I'm bringing this up because the Federal Reserve recently dropped interest rates another quarter point. So it's the second time they've done this in 2025. And there's reasons behind it. In fact, not only is the Federal Reserve dropping interest rates, so are central banks across the world. In the last 24 months, central banks across the world have dropped interest rates over 300 times over the last 2 years. This is the fastest pace and is equivalent to what we saw in the 08-09 financial crisis. Now, why are all these banks dropping interest rates? They're seeing weakness in the economy, as I shared before, with Chipotle, with historic credit card debt, auto loan delinquencies, but also unemployment. It turns out that long-term unemployment is over 25%. What this means is 1 in 4 unemployed Americans have been out of work for over 27 weeks. And the last time this number breached 25% was 2009, the Great Recession. And it really begs the question, does anybody really believe the 4% unemployment rate? And if you look at the charts from the Federal Reserve, we look at total non-farm payroll. Since July of 2021, where it was at a peak, it has been dropping ever since. Job postings in the United States, again, this is according to the Federal Reserve, have also consistently been dropping since 2022. The number of unemployed persons, long-term unemployment, 27 weeks or over, has been on an increase, a rather rapid increase, in fact, since about mid-2025. The unemployment rate across the board, no matter how you measure it, over the past year has been increasing. Annual wage growth has been on the decline for all wage earners, top and bottom and middle. And consumer sentiment, according to the Michigan Consumer Survey, for non-stockholders has been on the decline. It really points out the bifurcation that we're seeing currently in the economy. The top 10% of American households now own about 87% of all stocks, about 85% of all private businesses, and 44% of real estate. Another way of looking at this is the bottom 90% of Americans increasingly don't really matter in economic data. Now, this is a true bifurcation. I meet with people every week from coast to coast, all income stratas, all types of income and financial situations, and I see this firsthand. It is dramatic, the difference in consumer sentiment, perception, regarding whether someone has a large stock portfolio and their home is paid for, like I said earlier, versus those that do not have those two things. It is nearly a universal sentiment. When you have 10% of Americans doing well, feeling good about their financial situation, yet at the same time, 90% roughly not in that situation, that is not sustainable. That is not a good situation to be. I've shared this earlier also, that consumer spending, which accounts for about 2/3 of GDP, half of that is being accounted for by the top 10% of income earners. So our GDP, our economy, everything is increasingly being reliant on a very small percentage of people. And the stock market, as we've discussed many times, is increasingly reliant on just a small handful or two of companies. I've been repeatedly sharing on this show that the stock market has hit all-time highs, almost regardless how you measure it. And this includes 1929 and 1999, the highest levels ever recorded. And recently, the Shiller P/E ratio has now officially entered levels not seen since the dot-com bubble. It has broken over 40. And as the experts point out, this is not good. In fact, this is very, very bad. Every time the Shiller P/E ratio has gone to extreme levels, what followed was not pretty. And another measuring tool that I've brought up many times is the Buffett indicator. Now, this is a measurement of total stock valuation to the GDP. It is currently at 224%, which is the highest level ever recorded in the history of the stock market. This is the most overvalued market ever in history. And it's interesting, Warren Buffett's Berkshire Hathaway is now sitting on over $344 billion in cash. Did you know that Berkshire Hathaway could purchase 474 companies in the S&P 500 with that cash pile? That kind of puts in perspective how much cash that Berkshire Hathaway is sitting on and how much they've gone to the sidelines. They could purchase nearly the entire S&P 500. Yet, it begs the question, why are they not doing that? Well, it's really quite simple. Warren Buffett does not believe that it's a good value to do that. It's not a good time to buy. Buffett's nickname has been the Oracle of Omaha. It's well documented. He's one of the best investors in history, and I think it's valuable to pay attention to what he's doing. Now, many people are increasingly coming out and stating that the market is currently in a bubble. One of the most recent to add to that chorus is now Bill Gates, who has stated that the AI bubble is similar now to the dot-com bubble. And I found this interesting that Jerome Powell, the Federal Reserve Chair, he, at the same time, states AI is different from dot-com bubble and is a major source of economic income. So he's pointing out how the AI bubble is different than the dot-com bubble in the sense that the companies are highly valued, actually have earnings. But here's what he did not bring up, and here's where I have an issue. These companies are increasingly taking on debt to build the infrastructure for AI, like data centers and etc. And taking on, although they may be profitable companies, taking on debt and leverage is not a healthy sign. And why I think Federal Reserve Jerome Powell stating that the AI bubble is not like the dot-com bubble makes me more inclined to believe it is, because he's been wrong, frankly, on nearly everything. I've been a strong critic of the Federal Reserve over the last number of years. They kept interest rates too low for far too long. Even the Federal Reserve has admitted that recently. They did quantitative easing, which meant they purchased stocks and mortgage-backed securities for far too long, creating a tremendous asset bubble. Again, even the Federal Reserve has admitted that they made that mistake recently. Then they jacked interest rates up dramatically, the fastest clip in the history of the Fed. That's over 100 years. They haven't admitted this, but I believe they did it aggressively, and too aggressively, too quickly, and too high. And now they're starting to pull back and reduce interest rates. And if you look at the history of the Fed over the last 2 or 3 decades at least, you will see that they have a track record of overreacting dramatically, both to the up and the downside, which is a large part of why we're having these boom and bust cycles that we've been seeing certainly since 2000, let's say, or even before that. The Federal Reserve has been a large contributor to that boom and bust cycle. So their track record is really, really poor. What is the most likely scenario to occur? Extreme levels lead typically to extreme volatility. Also increases the chances dramatically of a correction or even a crash, a bursting of the bubble, which as this bubble continues to get bigger and bigger or higher and higher, the percentage or the level of correction can become quite much more dramatic and aggressive and painful. And this can all happen very, very quickly. Now, what do? The professionals, when risk is elevated, they scale back, selling off positions, reducing their market risk, putting their assets into guaranteed assets like Warren Buffett has done. Now, unless you have access to the bond markets or you're an institutional investor, that's somewhat difficult, but your personal bank could accomplish that. So can annuities. In fact, both of those have index products that provide unlimited upside gains with no downside loss. You can lock in gains. You can put in locks to the up and the downside. Again, unlimited upside with no downside risk and the ability to lock in your gains at any point. I'm going to share some more on this in the next segment. If you have some interest, I'm going to really encourage you to listen, because I'm going to pull back the curtain, like in The Wizard of Oz, and a little bit more understanding of how these index products really work, clarify or clear up some common misconceptions. So stay tuned.
This is Ference, host of the Your Personal Bank Show. Your Personal Bank is a financial concept that allows you to grow your money insured with guarantees, income tax-free, and highly liquid. Also, you have the potential to continue to earn interest on money you invest in other assets, purchase items, or pay expenses. How can you do this? First, invest in a high cash value policy to earn dividends. If you leave money in the policy, it'll grow like any investment, insured with guarantees and tax-free. Second, we establish a bank line of credit using the cash in the policy as collateral. When you access funds, you receive them from the bank. Typically, dividends earned are higher than the interest charged by the bank. You keep the difference. This is known as positive arbitrage. If you want to earn interest on money you spent or invest elsewhere, contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ference Toth. Want more information? Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ference Toth.
Welcome back to the Your Personal Bank Show. This is Ference. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Now, if you missed the first segment, I encourage you to go to the yourpersonalbank.com, our website, or the Your Personal Bank app. You can listen to any of this or any of the previously recorded shows. Each has its own title, so you can, listen to anything that might interest you. I have been discussing quite a lot over the past month or so about the historic nature of where we're at with the stock market, the S&P 500. Regardless of how you measure it, we are at the highest levels ever recorded, including 1929 and 1999. Folks, we're witnessing history here. Nothing like this has ever occurred, at least to this extent. But there are similarities, and as Mark Twain famously stated, history doesn't repeat itself, but it often rhymes. There are a lot of things that are rhyming about this market from, say, the dot-com bubble. Now, I'm not the only one saying this. There are many, many experts, economists, AI enthusiasts. One of the most recent who's joined the chorus that we're in a bubble happens to be Bill Gates. So there's some credible folks that are pointing out that we are clearly in a bubble. Asset prices are overvalued to levels that have never been seen before. And often I get the question, as people are becoming increasingly nervous about the fact that the valuations are at extreme highs. What do you do? Well, one of the best ways to allow yourself to continue to grab the whatever upside potential is left, because certainly the market can be, it's often known as being irrational longer than makes sense logically. And I often point out that when you're at these types of extremes, there's nothing logical or financial. You can't put any numbers to it. It doesn't make any sense. There's no logic in the valuations that we're currently seeing, particularly in some of these tech stocks. It's almost certain that the levels of valuations that they're at, the prices that they're at, they will never be able to produce the profits to justify these prices. It's just not reasonable. It's not logical. So what are we dealing with here? We're dealing with emotion, and that's what makes picking the tops and the bottoms of markets so difficult. It's often been stated it's impossible to do that. And the reason is you're dealing with human emotion. You're not dealing with facts, numbers, or logic. You're dealing with emotion. Human emotions are exceedingly difficult to predict. The two emotions that drive the market are fear and greed. And fear has a double-edged sword. There's the fear of the downside, but then there's also something called FOMO, or the fear of missing out. As the prices continue to melt up, there's the greed factor, but then there's also, gosh, I need to get in, or I'm fear of missing out on something, and that also pushes it to higher levels. But once that sentiment, the majority of people start to feel differently, where the fear of loss overcomes, or say 51% are more worried about the downside than the upside, then it shifts. And it can shift quite quickly and quite aggressively. I mean, literally overnight. And it's impossible to predict when that is actually going to occur, because you're dealing with millions and millions of people making decisions on a daily basis. So as I've often stated, what's one of the best ways to take advantage of the situation? What if it continues to go up for another year? It could. It could continue to go up another week, a month, or year. Who knows? Impossible to predict. Well, index products like index annuities, index life, allow unlimited upside potential. If you've looked at these products recently, let's say more than a year or two ago, the products today are the best we've seen in over 40 years. The numbers are the best in my career, in my lifetime, literally. So there are products available now that far outperform than anything that's been available previous. I'll use a quick example. I met with a couple literally today. Now, the wife was a client of mine, and we set her up in an index annuity a little over a year ago. Her return, we did her annual review for her, was 18.5%. So whenever you lock in the gains, she gets to keep those gains. So let's assume for a minute she had $100,000 and she got that 18.5% gain. So she has $118,500 in this account. Now that locks in. And then she goes from that point. And if the market goes down, say this second year, the $118,000 is It's locked in. That's the new principal. That's how index products work. They lock in the gains as it goes. Well, there's another factor that most people are not aware of. There's index products that allow you to do an automatic lock at any time or a manual lock. So let's say you invested in one of these index products and it went up 10% or 12 or 15% or whatever, and you're satisfied with that amount, that return for the year. Maybe it took 5 months to get there or whatever, half a year, 8 months. It doesn't matter when. It went up, and maybe you feel like things are not going to go up from here, or they could go down from this point. You want to lock that gain in. Well, you can do that at any point. Any day, you can lock in your gain, and then you have now locked that gain in for that year. You cannot lose from that point. Another way you can do it is you can do an upper and lower auto locks where you can say, I have a lot of my clients who had their annual renewals just in the last month or two. They're already up 6, 8, 10%. I'm looking at these reports just in the last couple of months. We can put a range. We can say if it goes below this, we lock in and can't lose any more than that, a lower range. And if it hits the higher range number, we're going to lock that and lock that gain in. So we can also do that band, the upper and lower bands, and lock in that gain for this period of time if it hits either of those numbers. So therefore, it can't go up and then back down again if you follow what I'm saying, and you would have lost out on that gain. The new products and these index products are tremendous. And again, no matter what we do, no matter what option we choose, the principal is guaranteed. And after you lock your gain in, that becomes your new principal. So never do you have a negative account balance. Year to year, your account balance will be the same or higher every single year, guaranteed. And with these auto lock or manual lock provisions, as I was sharing with you earlier, if we see a tremendous run-up like we're seeing currently, and you feel like you're comfortable with that or you're satisfied with that return, you can lock that in or put that range in, as I said earlier, so that if and when it does correct, you've locked that gain in. Now, there's another factor that I'm going to say 99% of advisors, agents, and stuff that deal with this have no idea of how to choose which index. So many of these products, these index products, by the way, I have access to over 600 of them, different indexes, well over 50 companies. I'm independent, so we can work with literally anyone, and we have proprietary software that allows us to look into all of these 600 plus indexes that are available and determine which ones, based on your situation, whether it's your age, how much you're going to want to fund, what state you're in, because these are all moving parts. These are all different factors. We can determine which is the best option for you, which index is most likely to get you the most upside potential. And then we can take a second level of that and go back and look at all the different 600 plus indexes and what has their performance been over the past 1, 3, 5, 10 years, etc. And that is something that, again, 98, 99% of advisors and agents do not have access to that information. I didn't for several years. This is my 26th year doing this. In my first several years, I didn't have access to it either. It's been a game changer. And this is why we're literally seeing folks receiving strong double-digit returns on their index products over the last several years, while I look at other products that people bring to me with annuities, index, life, whatever, and literally I'll see low returns. It's because they're not in the right indexes. They're in a subpar, and it's no different than, say, going to Morningstar and looking at mutual funds. We all know there's some that are better than others, that perform better than others, have better track records, better management. It's all of that. It's like a Morningstar for all these indexes. I have access to all that information. So if you want a no-cost, no-obligation look at what indexes would be the most likely to get you the best upside potential, contact me at yourpersonalbank.com or toll-free 866-268-4422, or you can even email me, Ferenc, F-E-R-E-N-C, at yourpersonalbank.com. The only information I would need from you is basically your age. If you give your name, that'd be great. I don't have to have your name, but the information I do need is your age, the amount you're considering funding or rolling over or transferring or whatever from another account, and what state you're in. And I can easily run that proprietary software and show you the top 3 or 4 indexes that would give you the best returns and have historically done so. Example I was wanting to bring up is I had this couple, again, client, who I helped her set up an index annuity a little over a year ago. Her return, like I said, our annual review a month or two ago was 18.5%. She got married fairly recently. Her husband had set up an index annuity with a different company, different product. By the way, the company was a good company. That was not the issue. It was a decent product, but had the wrong index strategies. His return over the past year, roughly the same time frame, was just over 1%. So here the wife is getting 18.5%, the husband's getting 1%. Obviously was not happy with that result. I was able to meet with him today. He had an 8% penalty to get out of that particular product. New product paying 14% bonus, so he's up like 6% immediately. And then showed him index products that have historically averaged last 3, 5, 10 years, anywhere from 10 to 15% range. That's what they've actually produced. And again, his wife had gotten 18.5% this past year, for example. That's not the highest. One of the better ones, I had a client recently have a 22% return. Most of my clients have been anywhere in the range this year, typically around 16 to 22%, unless they chose a fixed option, which some like to do. And we have fixed options that are in the 7% range. So if somebody says, hey, I just want the 7%, it's guaranteed, bird in hand, think of it like a 1-year CD, we have that option too. And a lot of them have chosen that because they don't want the risk of the unknown return, even though they understand there's no downside risk. But others who have decided to do that, and we look at the situation, their age, amount they want to fund, and what state they're located in, and find the best index options that have the highest upside potential, the best growth potential, and have the track record to back it up. Much like if you were going to invest in an index fund, an ETF, or mutual fund, you'd go to Morningstar and figure out which ones have got the better track record, right? But the problem with all of those types of investments obviously there is downside risk. Yes, they have unlimited upside, but they also have significant downside risk. And when you're in a position like we are right now, where valuations are at all-time historical highs, the risk to the downside is elevated. And what professionals do, if you listen to the show, you know, I was the chairman of the board of an FDIC-insured bank in formation. I worked with institutional investors. I have clients that have worked on the floor of the Chicago Board of Exchange, Wall Street. I understand how this works institutionally wise, and I can tell you the professional traders, when prices are elevated, risk is elevated, they scale back. And if you had the option or the opportunity to get into an index product where you have unlimited upside, great track records, great historical track records of double-digit returns over the past decade, plus even, you have the ability to lock in those gains at any time, and no matter what we choose, the principal is guaranteed, there's no downside risk, and each year or each time we lock in the gain, that becomes your new principal. That means you never lose money. And the old adage is, buy low, sell high, right? Well, the market's never been higher. When does it make sense to sell? If you want more information on this, contact me at yourpersonalbank.com. We got some more information on the behind the scenes. What are the insiders doing in regards to the AI bubble?
I'm Ference Toth, host of the Your Personal Bank Show. This is the golden era of fixed assets. Annuities and guaranteed lifetime income are paying the best rates in over 40 years. If you looked at annuities over 2 years ago, the numbers have increased significantly. If you own an annuity over 2 years old, the new products can not only pay your penalty to switch, but are often guaranteed to outperform your current product. For more info, contact me at yourpersonalbank.com or 866-268-4422. That's yourpersonalbank.com. This is Ference, host of the Your Personal Bank Show. Great news! Most insurance companies have announced higher dividends for 2025. They also reduced fees. This will increase cash growth even more than before. This is the best time in over 40 years to consider a high cash value dividend paying policy. Also, dividends are expected to increase for the next several years. Contact me at Your Personal Bank or 866-268-4422. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me. It's yourpersonalbank.com. Stock market is at historical highs, highest levels ever recorded, including 1929 and 1999. It's all due to this AI bubble or hype or whatever you want to call it. An increasingly small number of companies have been driving this, and it's literally a couple handfuls of tech companies that are driving all of this growth, historic growth of asset valuations. And what's interesting, I find, is what do tech insiders actually think of AI? This is quite revealing. Now, I've seen some articles on this, not a lot of them, but I also have discussed this with some of my clients that I have who, one of my clients was one of the original engineering team with Tesla, worked directly with Elon Musk. I've got some other clients who have some significant inside look of what's really going on in the AI world. And it's hard to ignore the fact that the AI hype has been significant. But when you discuss with some of the insiders, tech insiders, who work in the industry or understand what's going on in the industry, they sing a far different tune. And this has actually been circulating for a while, but it's been kind of quiet because the main issue that they have is they believe that the promises made by many of the leaders of the AI, the ones out there raising money for it, the funds and stuff like that, have made promises that far exceed anything of any type of reality. A lot of these tech workers, frankly, are afraid to speak up and call for a more moderate and realistic approach. And the reason is because they're afraid of losing their jobs. This is not an abstract threat because there are literally now thousands of tech workers being laid off in recent months. There's over $1 trillion of investment committed to all these different deals that OpenAI has done and NVIDIA and various other companies. So there's a lot of pressure for these AI leaders raise money and build up the hype and encourage everybody to keep going, because if this doesn't work out, there's a lot of money that can be lost. Androv Karpathy, who is OpenAI's co-founder, he stated they just don't work. They don't have enough intelligence. They're not multimodal enough. They can't do computer use and all of this stuff. He's been one of the few that's come out and openly stated that there are issues. Karpathy also stated you just can't tell AI agents something and they'll remember it. They lack cognitive learning. They have to start over. They forget. And he says it's going to take, in his opinion, about a decade to work out all of these issues. I've stated repeatedly on the show that I'm not negative to AI technology. I do believe it will fundamentally change the economy. But like Karpathy states, I believe it's going to take a while. It's probably going to take 5 or 10 years, as he stated, to work out all these problems, work out all these issues, so that we have an actual AI system that does at least some of what they're proposing or hyping that it can do. And we saw the same thing with the dot-com bubble. I mean, there was tremendous hype. I feel like it's almost like a time warp, folks. This is my 26th year in the financial industry. And then my first year or two is where the latter part and the peak of the dot-com bubble and the hype that was all around that. It feels remarkably similar. It's like, gosh, I've been on this ride before. I've seen this before. It's amazing how familiar the hype, the sentiment, the excitement, the enthusiasm, when you look at the charts, the numbers, everything else, it's amazing how similar it really is. And again, I'm not the only one saying that. Even Bill Gates stated that recently. What I'm getting at is I've been on this road before, and I know what comes around the next corner. I don't know if it's the next one or the one after that, but I know it's after one of these turns down this road, the bridge is out. I'm not generally a negative person. I'm pretty optimistic. But if you knew you're on a curvy road and it's dark, and you knew a couple of bends ahead that the bridge was out, and you see somebody speeding down the road, would you say something? That's what I'm trying to do. I'm trying to warn people and let them know, hey, don't just keep flying down this road because it's going to end badly. There's almost no two ways about it. The numbers don't work. The math doesn't math. There's all kinds of warning signals. Red flags are flying everywhere, historic levels. The industry is burning through cash at an alarming rate. They're taking on debt. Some of these companies are taking on tremendous levels of debt just to try to keep up, frankly, hoping it all works out before they run out of money, right? It could work out. I'm not saying it won't, but it could also blow up really badly like we saw in the dot-com bubble. And increasingly, as this keeps going and this bubble keeps inflating, the odds of it ending badly continue to increase. That's what I'm trying to say. And you don't have to ride this ride. You can still benefit from it. You can still get in a NASDAQ index with an index product, for example, and get strong double-digit returns if it continues to go up with no downside risk. You can lock in your gains at any time you want to. These are the kinds of things you can do. Those are available, and most people don't realize it. So not only am I saying, look, the bridge is out ahead. Don't keep speeding down this curvy, dark road because it's going to end badly. Not only that, there's an alternative route that's well lit, nice smooth road, and it'll continue to get you where you're going without all the curves and the bumps and the stress and the risk. And professionals, logical investors, when risk is elevated, when asset values are elevated, they scale back. They reduce their risk. Warren Buffett has done that in a massive way. I shared in the first segment that the amount of cash that Warren Buffett is sitting on, he could literally buy 474 of the Fortune 500 companies today, the S&P 500. That's the kind of cash he's sitting on, but he's not buying those companies because he recognizes the risk. He recognizes the asset valuation is inflated. It's just not a good deal. It's not a profitable deal. And I think even more powerful message than even any of that I shared with you is what are the insiders doing with their own stock holdings of these AI companies and these tech companies? Well, it turns out in the past week, there were over 200 insider trades. These are people who are executives higher up on the boards of various tech companies, AI companies. And just in the past week, over 200 insider trades were all sells. Every single one of them. Not one was a buy. So the insiders are selling. And if you take it even further, the CEO of NVIDIA recently was hyping the NVIDIA shares in his earning calls and then turned around and sold more NVIDIA stock. He's been selling a lot over the last, month or so, and he continues to sell. So on one hand, he's saying, hey, this is great. Yet on the other side, he is literally selling tens of millions of dollars of NVIDIA stock. Is that a good sign? I would say not. Pay attention to what the insiders are doing. They are selling. And we are seeing all-time levels of leverage in stocks. In other words, people buying stock on margin, things like that, borrowing money to buy stock, which again, as soon as you see a correction, that can go bad really fast. People can get margin calls. They owe more than they own, and then they're forced to sell. And that's something that can cascade extremely quickly and extremely aggressively. So it wouldn't take a significant correction with the amount of leverage that's involved right now in all these different stocks for there to be a dramatic reversal. And this could happen, in days. It can happen fast. And most people who own brokerage accounts and things like that, if they put in an order for a sell, these brokerage firms have 3 days to sell, 3 business days typically. Doesn't happen immediately, folks. And a lot can change in 3 days when you see a hype like we've seen. And if we see a correction or a reversal, it could happen very aggressively, very quickly. some other history-making news is the S&P is up, but the breadth, in other words, the number of companies of the S&P going up, is increasingly small number. In fact, it's becoming a tiny number of companies that are actually going up. It's all tech, basically, pushing everything up, where all the other stocks happen to be down. If you see an overall market going up and a majority of the companies going up, that's considered a healthy, growing market. But when a increasingly small number of companies are pushing it up and the rest are losing, that's not considered healthy. In fact, that's very unhealthy. Recently, we had a historical day in the S&P 500 that it had one of the worst breadth days in history. It was an up day. 104 stocks were up, but 398 of them were down. And that is a historical level that's never been seen. Those are signs of weakness. Those are red flags. That's when you want to start being cautious and start scaling back your risk. And as I shared in the last segment, index products allow unlimited upside potential gain, no downside risk. They guarantee the principal. So you're not giving up the upside. And I can do the research for you. I've accessed over 600 indexes, folks. We can find you the best ones that'll offer you the best upside potential. I've got folks making 16 to 22% this past year has been the average returns on these indexes with the downside guaranteed, and you can lock in your gains at any time, or you can set a range or a high-low range. If it goes over this, below this point, I'm out. If it's above that point, I'm out, and I've locked that in. You can do all of that with an index product, which guarantees you never go down. Your account value never goes down. And in fact, again, you can, when you lock in gains, that's your new minimum. That's your new principal. And you can lock those gains in any time. If you want more information on that, contact me at yourpersonalbank.com. Be happy to help with you, show you how you can continue to take advantage of whatever upside there is, but eliminate your downside and lock in your gains at any time, whenever you want. These tools have gotten so much better in the last couple of years. If you haven't looked at them, and maybe you did and you weren't looking in the best options out there. I see that all the time. I see folks getting into index products and they're in subpar indexes. Folks, are there subpar mutual funds, EFTs, things like that? Of course there are. Are there ones out there that have a better track record, better management, more likelihood to upside? Of course there are. Well, with index products, we have the same thing. And I have proprietary software that tracks the 1, 3, 5, and 10-year results of over 600 different indexes. Depending on your age, the amount of funds you want to invest, and what state you're in, we can find the best options for you that are available. And this is something that easily 98, 99% of advisors or agents out there do not have access to. It's a game changer. This is why we're getting the returns we're getting for folks, especially when I'm comparing when they have another product already. And in most cases, we're getting double, triple, and even quadruple returns than what they were receiving earlier because, frankly, they were just invested in the wrong indexes or subpar, very poor choices. And it's not necessarily the advisor's fault per se, because without this software, how do they really know how these indexes perform? It'd be like trying to buy mutual funds without looking at a Morningstar report. I wouldn't recommend that. I don't think anyone would. You want to know what's the management, what's the track record, etc., things like that before you just purchase it blindly, right? That's what we do with these indexes. And unless you have the proprietary software, and again, 98, 99% of folks don't have it, advisors and agents, they're flying blind, frankly. It's not their fault. They're flying blind. If you want more information on it, I'll share with you and show you what options are available out there that you could do so much better to the upside with no downside risk. Contact me at yourpersonalbank.com for more information. Stay tuned in the next segment. I got a few things about government benefits that if you haven't heard about this, it's going to piss you off. You need to know where some of your tax dollars are going. So stay tuned.
This is Ference, host of the Your Personal Bank Show. My show focuses on creating tax-free buckets of money, insured, guaranteed, highly liquid, and the ability to create positive arbitrage. Did you know this is the best time in over 40 years to invest in index annuities? An index annuity allows you to 1. Grow your money safely without market risk. Once gains are locked in, they're guaranteed against future market loss. 2. Double-digit potential upside on good market years with no losses in bad years. Principal is guaranteed. 3. A 7 to 8% fixed interest option is available in the first year. If you're interested in growing your money with potential index-related gains without downside market risk, this is the best time in over 40 years to consider an annuity. If your annuity is over 2 years old, the newer products likely have far superior potential returns. Please contact me at yourpersonalbank.com or 866-268-4422 for more info. That's yourpersonalbank.com.
Welcome back to the Your Personal Bank Show with Ferenc Toth. Want more information? Contact Ferenc at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. Now back to the show with Ferenc Toth.
Welcome back to the Your Personal Bank Show. This is Ferenc. If you want to reach me, you can do so at yourpersonalbank.com. Yes, you will reach me, yourpersonalbank.com. I've got an issue here I need to bring up that more and more people are becoming aware of, and the more you learn about it, the more it pisses you off. And it has to do with the food assistance, what used to be known as the food stamp program, or now known as SNAP benefits. According to the federal government, over 42 million people in the United States are receiving SNAP benefits or food assistance. Comes out to about 1 in 8 people living in this country. Only about 10% are disabled. Also, nearly 60% of SNAP recipients are not citizens. Now, what's really disturbing about this is since 2019, pre-COVID, the numbers have doubled. The reason behind that primarily is the U.S. was flooded with illegals, and what happens is when that family has a baby, the entire household now becomes eligible for SNAP, food assistance benefits, and U.S. taxpayers get to pay for it all, which frankly is a scam. Average SNAP recipient spends more on non-essential food items than the average person who pays for their own groceries. What does that mean? People who are funding the program, taxpayers, and whether you pay payroll tax or income tax or whatever, is being used partially to fund this food assistance program or SNAP program. So it turns out that the people who are funding the program, the taxpayers, the working Americans, the citizens primarily, are living more modestly than the people who are on the program. This is outrageous and it's disgusting. Once you start to realize it, it should piss you off. Also, the number one thing that artificially inflates the price of groceries is the food stamp program. You see, the federal government is subsidizing groceries for over 40 million people. That obviously drives up costs. It's basic supply and demand. Roughly 30% increase in groceries over the last 4 or 5 years that we have seen. These are numbers according to the government. Personally, I believe they're higher, but let's go with the government statistics. You match that up with the number of people that have been added onto the SNAP program, and you realize that's why grocery prices have gone up. So you're getting scammed twice, paying for the benefit through your taxes, and then because the government's giving so much money to so many people, it's driving up the cost of groceries, so now you're having to pay more for your food. Americans are generous people. We have no problem helping somebody who is genuinely in need, but most Americans do have a problem with helping illegals, lazy Americans, people who are scamming the system and making this a way of life. It's not helping the poor, it's rewarding people who abuse the system. And, welfare is evil. It's actually the primary cause of dumbing down, depressing, and creating dependent citizens. Turns out 44% of SNAP recipients are obese, 24% are overweight. SNAP is not saving people, it's actually what's killing them. And the reality is the SNAP program should not be allowed to continue until all recipients reapply and are approved under far stricter standards. Any legitimate recipient should welcome this audit. In fact, the Department of Agriculture should audit SNAP recipients with the same zeal and aggression that the IRS audits small business owners. The reason they're doing this is the government wants control of these programs so they have control over these people. And withholding food is a great way to get people to do what you want, which happens to be very common in socialist and communist countries. The only people that should be eligible for SNAP, U.S. citizen, permanently disabled. Otherwise, in my opinion, much like welfare, they put a 2-year lifetime maximum. That could be a good solution for SNAP. SNAP is designed for somebody who's fallen down on their luck. You don't want somebody going hungry, but it's not designed to be a permanent lifestyle. And the solution really comes down to this. Do you want cheaper rent? Deport the illegals. You want more available housing? Deport the illegals. You want more jobs? Deport the illegals. You want increased wages? Deport the illegals. You want safer streets? Deport the illegals. You want cheaper auto insurance? Deport the illegals. Better access to medical care, particularly emergency care? Deport the illegals. You want to get rid of overcrowded classrooms and have a better education for your kids? Deport the illegals. You want fair elections where only U.S. citizens vote? Deport the illegals. The solution is quite clear. And that's why I'm very excited to hear that ICE is now fining employers for violating immigration laws. Going after the illegals is one thing, but if you go after the benefits, the jobs, the SNAP benefits, HUD has now also announced that you have to have a U.S. citizenship requirement for housing, and they've announced that nearly half of all HUD recipients were illegal aliens. You remove the incentives, many are then going to self-deport, which is the best solution because they shouldn't have been here in the first place. If your first act of coming to a country is breaking their laws, that is not the type of character person you want in your country. They need to do it the right way. And economically, it would reduce inflation, reduce the cost of housing, reduce the cost of insurance, food, many other things that are causing a real challenge economically for millions of Americans. That's the solution. If you want more information, how to navigate the historic valuations we're seeing in the markets, you want to continue taking advantage of upside gains, we can research the best indexes available. I have over 600 of those available with no downside risk. Or if you have an index product, whether it be a life or annuity product, and you want to compare, no cost or obligation, I'll show you better indexes that in most cases double, triple, even quadruple your returns, again, with no downside risk. You want to have the ability to lock in your gains at any time or set high-low ranges? We can do all of that. Contact me at yourpersonalbank.com. Stay tuned next week for some more great information on the Your Personal Bank Show. And as long as it's on our money, in God we trust.
Contact Ference at 866-268-4422 or yourpersonalbank.com. That's 866-268-4422. This show is designed to provide accurate and authoritative information. The presenter and guests of this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Some products discussed may have limitations and not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage.
Concerned about market risk? I'm Ference Toth, host of the Your Personal Bank Show. The S&P 500 valuations are higher than at any time ever recorded in stock market history. This includes 1929 and 1999. We all know what happened afterwards. It wasn't pretty. Elevated valuations increase risk to the downside. Annuities and Your Personal Bank offer unlimited upside with no downside market risk. Your principal is guaranteed. Contact Ference at yourpersonalbank.com to maximize returns, reduce market risk, increase liquidity, and reduce taxes.